Can VVIX be an effective trading signal?
No, let's go. Next subject. Just kidding.
VVIX, which measures the implied volatility of the fear index, the VIX, it reached its third highest level in the past decade during the August 4th kind of market pullback, meltdown, whatever you want to call it. Okay, that was the third highest measure of volatility on volatility. You know, when I was in Mexico and I was giving a lecture last week, one of the people in the crowd at the end of it, they did a Q&A, and one of the people in the crowd said to me, with all the zero-day options, with AI, and with everything that's going on with the speed that we disseminate news, do you think that essentially volatility trading, like the VIX trading and stuff like that, is a thing of the past? And my response was, you know, what's so interesting about the question is, I just want to know how somebody, first of all, I said the answer is absolutely not. And I said, the funny thing about that, though, is that, just think about this for a second. How would you ever fence in fear? Like, how is it even possible to fence in fear?
I don't think you can.
I know you can't. Like, it's not, you cannot fence in fear. It's not something that you have any control over. Very interesting. This is an example here of kind of just, it gives you a really good graph of looking at the size of this move. Third largest move in the past decade. Okay, so let's go to the next slide. Data indicates that the long-term correlation between the VIX and the VVIX, let me move my slide over so I can read this better. The VIX and the VVIX is 0.84, which means when you think about something 0.84, that means they're highly correlated.
Sure.
Okay. So volatility on volatility and volatility, they're highly correlated. Okay. No.
0.00 is exactly correlated.
Yeah.
Right?
Okay. No surprise there. Meaning they move in the same direction most of the time. The correlation makes sense because a rapid rise in the VIX typically suggests that the market's in panic mode. We all agree. Let's go next slide. So we're looking here is kind of the relationship between these two. Given the unique relationship between these two, we wanted to explore what their combination can help us understand, if their combination can help us understand the market better. And maybe it can give us some insights into our trading and trading performance and all that. So what we're going to do is we're going to test the ratio of VVIX over VIX. So that's VVIX divided by the VIX over the past 10 years. And what we found, go to the next slide, what we found is that since 2014, 10 years ago, the ratio had stayed between 5 and 7, 60% of the time, with the median of being 6. Currently, the ratio is 6.19 as of yesterday. So this year, there's only one day, the entire year, where the ratio fell outside of between 5 and 7. It went down on 8.5, it dropped down to 4.5. Now, what that means, 4.5, obviously, when volatility explodes, the ratio goes low. When volatility is dead, the ratio goes high. And the question that we're going to ask is, when that ratio gets really low, is that a really good indication of when we should jump into the markets and be more aggressive?
Don't know the answer.
Okay, let's take a look at the next slide. To test whether this ratio can be used as a trading indicator or a leading indicator, we looked, and fewer than 17 of the occurrences of the whole year were greater than 7. So we're going to use thresholds of 5 to 6 to test option performance. Below 5, 5 to 6, and above 6. We're going to analyze the performance of selling 45 days to expiration, 1 standard deviation strangles with 21 DT management over the past decade, okay, for each scenario. The results showed that the average P&L decrease as the VVIX VIX ratio increases. Performance is worse at higher ratios, showing a negative P&L and greater downside risk. So that means when volatility is really low, means the ratio is over 6. When volatility is really high, means the ratio is closer to 5, all right? And normally the ratio averages around 6. So you can see here, when volatility is really high and the ratio is really low, the average P&L in the strangle is $101. When we're at average P&L was $46. And when volatility is super low, the average was minus $45. So you lost money.
Big swings.
And you also had much bigger losers, largest loss, when volatility was really cheap. So the crazy thing about this is that when you look at the VVIX divided by VIX ratio, the percent of occurrences, most of them happen when we're right in the middle. Sure. But the success rate also is going to be pretty much the same. But you make more money and you take largest losses significantly less when that ratio is really cheap. Okay, so should we use this ratio to figure everything out? So why does a low ratio lead to better performance? And we found the ratio decreases when the market falls significantly, which pushes up option premiums. That's how come we make more money. But now go to the next slide. Then we tested the average VIX and VVIX within these three categories. And we found the higher the ratio, the lower the VIX. This simply implies that strangles underperform in low IV markets, consistent with our findings all along when looking for IV levels directly. So we found was that the median, well, let's do this. We found when the ratio was between 5 and 6, the average, where it is right now, just over 6, that the VVIX is around 98 and the VIX is around 17. Right now, because we're a little over 6, the VIX is,
You looking at VIX?
yeah, 16. Where's the VVIX? I don't have to see it in front of me. It's a little bit, well, it's 6.19, whatever it was, but the VVIX is a little over that 98 and the VIX is a little under that 17. But you can see that when the number is over 6, generally it's 91 and 13. And when the number is under 5, it's 105 and 25, which is really good. What that means is examining the VIX and the VVIX together can provide a deeper understanding of volatility and potential market direction. The VVIX VIX ratio can also serve as a trading signal for option sellers. The lower the VVIX VIX ratio correlates with better performance. But here's the biggest takeaway of it all. The IV or IV rank is a more straightforward and simpler signal for most traders. They serve the same purpose. So what we have been doing all along using IV or IV rank actually makes more sense and works better because it's more straightforward. You don't have to figure out ratios. So basically what we're saying here is that if the IV or IVR is super high, obviously the
You
numbers,
have everything in place to look at selling premium strategies.
numbers just work out much better.